now that we're all settled, I will introduce myself. Some of you know me. Marty has given a few of my bullet points, but just quickly, I spent a career as an entrepreneur. I still consider myself that kind of person and still start companies, but I've kind of shifted roles now, and I'm on the other side of the table where I'm more of a business catalyst as an attorney. I've got my own practice where I do a lot of M&A work, but we'll talk about other people's practices today as well, specifically David. It varies from sports, technology, biotech, Web3, et cetera. So I moderated a lot of these panels. I do teach at NYU, which is something that Marty mentioned, and involved in a bunch of other stuff inside and outside the family office world, but you didn't come to hear me speak. You came to hear these guys speak. So I'll let everyone introduce themselves very quickly. And I'll start with Chris Anci over here.
Hi, I'm Chris Anci, 30 plus years in financial services, both on the buy side and the sell side. Had my own broker dealer, specifically was kind of a trading shop and also a fund administration company. And for the last 8 years, been working with a prominent real estate family here in New York, running their family office on the CIO side, running non-correlated private equity investments.
Hey everybody, David Kramer here. I am an attorney at Greenberg, Glusker. I do my practice is mostly comprised of private placement work for family offices, funds, high net worth individuals, and I do the other half is M&A. Historically, it's been mostly buy side. For the last little bit, I've done a decent amount of sell side too. And like I think Renee, I'm a native New York City boy, but I've been out in LA the last 13 years, so it's good to be home.
Trader.
True.
Hi, Richard Brand. We just sold our company. I was a CFO. We sold it for a 5x multiple over the comp that closed 3 weeks before. Born across the river. That company was in Birmingham, Alabama.
I'm Eveline Gerck. So I started as investment banking as an analyst with II rank twice. Then I moved to private equity, was in 2 funds. The first one at TCW was middle market. Then we had another $1 billion fund that was investing money for 5 family offices. And then I moved to work for Alpha Square, another family office, $2 billion fund. And now I'm on the board of 5 funds. And one of them is the K funds. I'm on the advisory there. So we can talk about things from the K funds and the other funds.
Okay, well then let's get into it. When I'm giving these kind of topics, it's kind of like taking a Rorschach test where it's like, I see the ink blot, mergers and acquisitions, it's a vague enough ink blot, so we're going to take it in a number of different directions. But, you know, inflation is still pretty stubborn from a macro standpoint. And, you know, my question for the group is, how is that affecting M&A and how is that affecting companies in terms of their exits? Because you think about when companies get seeded or when they get funded, there's really 2 paths, right, for an exit. One is what we're talking about, which is M&A, and the other is an IPO. So how has the macro affected the M&A market, and how is the future of the macro, in your view, will affect that?
Well, obviously, over the last year and a half, the macro has greatly affected the M&A market in terms of freezing it, and it's been gummed up quite a bit by interest rates. We really didn't see anything done on the quote unquote mega deal side. But I do think that this is going to be changing pretty soon because there's pent up demand and there is a lot of cash on the sidelines. So inflation has abated a bit, rates have come down a bit, but at the end of the day, business needs to get done. And some buyers need to acquire and some sellers are anxious to get out. So I do think that while everybody is cognizant of the environment in terms of a macro perspective, I think people are going to be forced to get things done. Maybe, you know, in sort of the public side, you may see all stock deals because they may not actually, you know, go to the debt markets considering the cost of financing. And then on the smaller and middle market size, they'll figure out how they're going to do it. But I think everyone's going to have to get used to the world that we're in and the uncertainty thereof, but they got to get back to business.
Yeah, the thing I saw the most last year was just a disconnect on valuations. So, you know, you had buyers thinking they were going to pay a multiple that sellers no longer would countenance. And that was a major pushback from, let's say, 21 and maybe even the first part of 22. And then as far as structuring, I think given where interest rates are and the high cost of debt, I've seen an increasing amount of seller financing to try to creatively close the gap and keep sort of sellers in the game and sort of motivated and tethered to the deal, but still allowing buyers to free up some of that capital that's so precious and hard to come by now.
Yeah, first part of this week, we saw the announcement of the third acquisition in London between REITs. Now, who had that on their bingo card for Q1 of 2024? REIT mergers. So there must be something going on, but I've always believed that, we have to be very sensitive to the market, but sometimes the market forces us to do things. Like I wanted to IPO this last company, like we IPO'd my prior company, but the window was shut. And we just turned down a deal in 2022 and negotiated an even better deal in 2023 in a market where there was very few deals being done.
So I want to talk about like two funds. One is that I'm on the board and the other one I'm an advisor. So one is like the early stage, like seed stage investment. So in that universe, you see funds really trying to exit and try to, return some capital to LPs, and it's brutal. So some exits that we have tried to do end up going like with strategic large corporations, and they just like taking their time, like 1 year to, really close a deal and come with like valuations that are not what you're expecting. And then doing like a stock swap, then they merge with another thing they have. So it has been really hard for early stage funds to exit. In the other side of the spectrum, like funds like the K funds that Gary just mentioned, those are companies that are, better capitalized. They're really like, with a different stage. They take advantages, and then they are making a lot of acquisitions. We had a couple companies in the K funds that made acquisitions, very interesting valuations. So again, depending on the side that you are on the table and how capitalized a company is a great time to be buying. And if you are, in the smaller VC funds, they are trying to return money to investors, and they are in a very tough spot right now.
Eveline, let's stick with you and let's talk about the early stage, because this is where everything starts. So how does the analysis and how does the horse picking at the early stage side change when money is tight? Because when money is free flowing, everyone remember an app called Clubhouse in 2021 that was all the rage? Anyone? Oh yeah, okay. Anyone know where they are right now? Exactly. That was $1 billion company, and there were no fundamentals that underlie that. And when markets are tight, I believe that there's always a return to fundamentals and the basics. So the question, or phrase as a question for you, Eveline, is how does that change the calculus on the early stage side if you're an investor? Or does it?
So I see for the early stage, number one, we are much more careful. Last year, we only made 2 investments. So you used to make like 5 to 6 investments a year. And those 2, like one of them was kind of strategic because it would be a merger with one of the companies in the portfolio. And so regardless of how you analyze, what I think that the early stage funds are doing right now is sitting on cash. And that's people keep saying that you have a lot of dry powder out there. So I don't think it's a matter of like, I'm going to do a better analysis. I'm going to have a better understanding of this technology. They're really like sitting on cash right now. So that's what I see out there. So I don't think it's a matter of like, I'm doing a different strategic analysis. I want to be in, even though you have the AI area that everybody's really excited about it, the smaller funds, they're just sitting on cash because you don't know what's going to happen with the portfolio right now.
Got it. David, I see you almost gesturing for the microphone. And so I'm going to use that as a segue to cue into you. But I have a different flavor of this question. So you had alluded to deals aren't getting done, or deals have to be more creative, or people have to be more, excuse me, creative with their deals as far as pricing and structure and all of that stuff. What kind of interplay is there between the existing investor base with a company that's hoping to do a deal and what they were hoping to get out of it versus, where you sit as a lawyer and what you're trying to get done and what the expectations are versus what the reality is on the buy side or the acquirer side?
Yeah, so a couple of things to say there. First of all, I think the mantra was, let's say 20 to 22 was grow scale, grow scale. And then almost overnight, you had all the private equity and venture shops say, where's the bottom, like what happened to the bottom line here? And it was a very frustrating disconnect because founders were saying, hey, you were the ones putting money in our pockets and telling us to grow and scale. And overnight, you've cut off the spigot and are now criticizing us in a sense for executing the strategy that you asked us to execute on. As far as where I sit, one of the few good things about being a lawyer is you don't necessarily have to bet on the winners and losers. We want all of them to win, of course, but
Yeah, we get paid regardless.
right.
Yeah.
I didn't say that. But just as a matter, we do have a nice pulse on sort of deal flow and where things sit. And someone mentioned that in the prior panel. I was thinking about this panel today. In 2022, I did almost 24 sort of early stage financings. In 2023 is about half of that, right? And I think, we'll see where 2024 shapes up, but you sort of have a pulse on the market just from what comes across your desk. And so that's sort of what I'm seeing out there. And I think just more squarely on your question, as far as how, what happens on the creative side and whatnot, you're just seeing a tremendous amount of down rounds and founders having to just accept the fact that whatever they were getting paid and valued, 2-3 years ago, it's a fraction. And I think a lot of people are eating a lot of humble pie as a result.
Damn, I'm hungry. Chris, did you have something to chime in on this before I shift topics?
Yeah, I'd like to just give a little anecdote to what you were just saying. We had a portfolio company that was kind of a high flyer, a little bit of a COVID baby in terms of having everything get ordered in. Let's just say they sold pretty cozy loungewear, and the government told you to sit home and watch Netflix for a year and a half. So they definitely did quite well. And then a relatively large, investment banking firm told them to do exactly that. Go out and acquire other brands. So the juggernaut was then financing 5 other brands in order to get a much bigger valuation. Well, let's just say that the founder got crammed down to about 3%. The valuation is down below what the whole thing turned out to be a mess. So I think that that's a very interesting trend. And then also in terms of down rounds, we saw last year that a lot of, A rounds kind of got done from what we're doing. We're doing small. We do like $7 to $15 million Series A stuff. So we could kind of get that stuff done, even though some of our high net worths were like, we're rolling treasuries. And I'm like, I'm competing with treasuries. I mean, this is the first time in a very long time. But anything Series C and later was going to be a down round. So I do think that someone's going to have to swallow it. And like I said in the intro, I think that everyone's just going to have to, stop, they're going to get what they have to do and not what they want to do. Kind of a thing.
So because I'm an equal opportunity MC here, I'm going to go to you, Richard, for the next question, then we'll pop around. So what was alluded to, and David alluded to it, is that there was always this idea, and especially in Silicon Valley, it's probably the most prevalent, is that you grow, scale. You don't care about profitability. You don't care about simple things like making money. Who cares about that? Is that the pendulum always swings back when monetary policy is less tight? Do you think that we've changed fundamentally in that we will swing, we'll permanently be focused on fundamentals, or we're just going to swing back to grow and then sell to whoever it might be, to the bigger fish?
Yeah, I want to live to the next century, right? Because we've had these, when we went in 1999, we had it in 1899, we probably had it in 1799, and then we had it more recently. But, from an operating perspective, when you're operating to go IPO, you consciously manage a certain way, different than when I managed my departments on Wall Street, right? But then when the IPO window slams shut, even though Morgan Stanley's ready to take me out, then I have to pivot. And one of the happiest days in my life was when I got my founder to agree to knock expenses out of our equation equal to 40% of our revenue, including one of our co-founders. I mean, it was always in the back of my mind. And then once interest rates rose and the IPO window shut, I said, my investor base here is not going to wait around for the next IPO window. So we got to manage to cash flow. And it was draconian. And if you have a company with 51 people, you know everybody, right? And it's hard to have those conversations. It's easier when you have like a huge Fortune 500 company and you do a riff. But when you're doing a riff and you're one of the guys you're whacking is the co-founder, it's a very personal situation. But we got it through and you know, saved the company.
A couple of things. One, I appreciate your usage of mafia parlance and whacking. And then the second is that, you know, I don't think I want to live till the next century like you. Party like it's 2099 does not have the same ring. So let's shift gears for a second and talk about sectors, right? Because you know, in preparation for this panel, I read every shop on the street and what their forecast was for 24, and everyone's got an idea of what sectors are going to make sense. So let's each of you, and I'll start with you, Chris, because you're right next to me. You know, in terms of where you see the most opportunity for deals to get done, from a sector standpoint, which ones do you like the most?
You know, first I'd like to say, like, we all have a tendency to take these things with broad strokes, right? And there are companies out there, you know, that are making another shampoo, right? Now, whether or not that is going to get the valuation that it could have gotten 4 or 5 years ago, I mean, we don't know. And does the world need another shampoo? I don't know. But then there are other companies that are solving real problems. You know, I tell my kids all the time that the entrepreneur does 2 things. It either shrinks time or it solves a very particular problem in a very particular business, right? I said, we're not going to solve the next, you know, plumbing issue, but a plumber will, and probably will make a lot of money at it. So in terms of the M&A business and what we're talking about here, you know, the behemoths, you know, the data center businesses, all of those things, they need next gen stuff. And there are people out there either in garages or Caltech that we heard earlier or whatever that are actually tinkering in the right spaces and solving the problem that specific industries needs. And I think that there will always be a bid for that. So obviously we've heard that AI is hot. I think you're going to see deals in the energy side because I think the Inflation Reduction Act and a lot of this government stuff, you know, is you know, fiat from the top. I'm not a big fan of that. I prefer more grassroots movements, but I highly doubt government would have built the iPhone. But anyway, it's driving a lot of stuff in the energy sector. I think you're going to see pharma, not specifically healthcare, but I think you're going to see some movement in pharma, and then always tech, like I said. Tech is out there solving problems for particular businesses, and I think that's going to continue.
I'm gonna shake up the order because I realize this is kind of question where thunder might get stolen very quickly. So Eveline, I'll kick it to you.
Yeah, so, you know, a few years, if you look at, you know, when you talk about what is the trend right now, first I wanted to say that in the past 3 years, first everybody had to be in digital currencies, then everybody had to be in Web3. So it's just like this. So now everybody wants to be in AI.
Well, if you look at the price of Bitcoin, you know, it's not, that thing's come all the way
Yeah,
down.
people, yeah. So what I see is that a lot of, you know, not only VC-owned or private equity-owned companies, but everybody's trying to have some AI technology in their company. So they are shopping around for like early stage AI players that they could acquire and, you know, have the technology, the company, because it's much easier than to try. Some of them are trying to develop AI internally. If you're not like AI driven, let's say, if you're like a supply side company, enterprise software, SaaS type of company, and want more AI, you're not going to like keep developing your AI. It's much easier to go and try to buy the technology. So I see this shopping going on right now. And plus, if you want to buy a real AI, look at the valuation of ChatGPT now. So you're not, you know, it's out of control.
We have questions. Sir, what's your name over here?
Yeah, who are you?
Wait, actually, this is much better. Sorry, I'm also hosting and producing.
Yeah.
Do you know the term greenwashing or astroturfing? I'm wondering if there's such a thing as AI washing these days.
So what is AI washing?
There's definitely AI washing in the public market.
Yeah, I know,
You
but
see-
let's let's not speak in terms of art. I think what you're alluding to is something that like one of my favorite topics is buzzwords. We use them so much, they don't mean anything. Okay. Like to me, every Silicon Valley, I'm sorry, I'm turning this into a stand-up act or a TED talk, and I apologize. I'm gonna give it back to our panelists, but someone asked a question, and I felt the opportunity to respond to it. But like every Silicon Valley pitch, in my view, always use like the same 5 buzzwords, and it just depends upon what's de rigueur or what's of the time and what's hot and trendy. So we have a scalable AI blockchain drone company. I'm like, great, I don't know what any of those words mean. Okay. And so I think that's what am I right? Okay. So now you guys can respond to it. You've heard my opinion, but I'll keep mine to the side.
Yeah, go.
But I was going to go from AI to answer your question about the hot sector. So should I do that or should we stay in the AI washing?
I mean, you might as well pick up the question. I think it's a fun topic.
Then we can talk about the AI washing. So what I see, a lot of interest right now from the LP side. Everybody's looking again a lot in health tech, which they were scared before because of all the home stuff. So and like a lot of panels yesterday about biotech, but a lot of interesting health tech, a lot of interesting.
Let's actually correct the behavior that I just complained about. Give us some examples of what you consider like qualifying as health tech. Not that people don't understand.
Yeah. So
drill down.
So what I see people looking is like, again, health tech has AI, so you don't like the AI washing. Companies that are like for testing, we've had a lot of interesting testing, a lot of interesting anything that's related to oncology right now. And so the other side of the coin that I see that is coming back after the ESG washing is climate tech. And again, that has a political venue here. So if, Biden remains in office, so everybody expects another 4 years to push in this sector. So, and that's why people are like, still a little bit on the fence, but I think that's going to be a big push. If Biden is reelected, I think with that big plan, and then I think have a lot of investments in that sector because it's kind of interconnected with a lot of like investments that the government is making. And the other area is, even though we talk about venture capital, but you do have also investments in early stage and also growth equity in infrastructure. So that's another area that I see people, primarily family offices, they like that. It's not like real estate, but infrastructure is something that, they see in the very, very long term. They can sit in an investment like that for like 20 years. So that's the other area that I see interest. But now you can talk about AI washing.
Well, I'm so frugal that to go to the JP Morgan Healthcare Conference first week in January in San Francisco, I flew into San Jose Airport and everything is AI. I mean, you guys are right. So it's crazy, but I'm seeing it now that I'm being deluged with business opportunities. But the interesting thing is like in healthcare, finally, in certain segments, we have enough data that we can actually use machine learning or AI. So again, it's a question of can I and can we figure out, is there a real there or am I looking at a nothing burger with a bunch of slogans on it? Maybe some of these pictures are generated by chat or AI, right? Because it has a drone and it has AI and it has all the buzzwords in it.
Okay, fair enough. By the way, if you're keeping score at home, that is two food-related euphemisms: humble pie and nothing burger. So the over is 2.5. So we're getting really close.
I just want to chime in about, I don't know, maybe it was during the summer, there was a quick article that said that downtown San Francisco may be coming back office market-wise because some AI company signed a lease. So I called my colleague up in San Fran and I said, "Oh, what's going on there?" He's like, "Bro, I know that company. It's 3 guys. They took a room." So that's so if that's indicative of where we're going with this whole thing, I think as we learn, The 2.0 versions of a lot of these things are the better opportunities because you tend to catch the high flyers and then you end up getting burned. So as somebody said earlier, you know, the phoenixes that come out of that initial crash are usually the better opportunities for everybody. So I think AI 2.0 is going to be very, very exciting, specifically on the healthcare front, right? Because I have read that they are, like, some of these machines, they're just churning 24/7, producing like 1,000 synthetic proteins and just kicking them out and stuff like that. So I do think there is some, you know, validity there, but it's definitely swimming in the deep end as of now.
I don't have much to add on the AI front, but if I can go back to the prior question.
Yeah,
I'm sorry,
absolutely.
to
Filibuster
us.
away if you need to.
No, so it's a specific answer, which is sort of the nutraceutical wellness space. I'm seeing a lot of movement there. I think people are increasing.
Yeah, define that. I don't know if you were
Oh,
getting into, yeah.
Sorry, I should use some buzzwords like
Yeah,
leverage and optimize and.
Nutraceutical in and of itself is a buzzword.
Sorry, so, you know, good point. Dietary supplements, you know, specific functional food and bev. We're seeing a lot of people, and I know I'm a little jaded being in Southern California where people tend to care about these things a lot more, although I've been sort of surprised walking around the streets of the city, seeing it here too. People are increasingly distrustful of FDA generally, I think, coming out of COVID. I'm not a conspiracy theorist. I'm just reporting what I see and hear. And I
just listened to a lot of Joe Rogan.
Yeah,
Coincidence.
right, exactly. And I think so. We're seeing a lot of people looking for alternatives and things that are considered to be wellness products generally. They're very, very high margin businesses. I think it's estimated to be a $400 billion market this year. So I'm seeing a lot of action there, and I expect that to continue.
Okay, Mr. Attorney, can I ask a couple follow-up questions? So this is fascinating to me. Nutraceuticals, people are skeptical of the FDA. Is that a hot market because it's either lightly or not regulated? Is that part of the calculus there?
For sure. Yeah, it's there's a statute from '94 that sort of has some very, very light guardrails on how these products are produced. You basically can't tell people that your product cures COVID or cancer, and I mean that's not legal advice, but as long as you steer clear of that, you're typically okay. And so if you disclaim the product up the wazoo and you can convince people that it actually somehow achieves certain benefits, people are all in.
Yeah, and there's a spectrum, right, between the pills with the animals at the gas station versus, you know, stuff that's got actual benefit.
Yeah, or perceived actual benefit, right? You know, and again, I know I'm coming from a little bit of a jaded perspective because in LA people will happily pay $22 for something called kombucha, which I still don't fully understand what that is. You know, and so I recognize that, you know, my perspective may not be the same as someone sitting in, you know, let's say the center of the Midwest. But, you know, I think as someone alluded to earlier, a lot of creativity, and Marty was saying it, a lot of creativity comes out of California. And to the extent that's a trend of where the rest of the country sometimes follows, I think this is an area we're going to see a lot of growth.
See, this is fascinating to me. It just shows that time is a flat circle, right? How many people here studied U.S. history or remember U.S. history? Anyone remember a little book called The Jungle by Upton Sinclair? You know, but you know, nobody cares that, you know, you could have been eating people meat at the turn of the last century. So I would not have wanted to been alive at 1899. Maybe the next one will be better. So like that's just, I got to point that out because that's fascinating to me, but apparently there's money in it. So let me give a little spin on this question because you had alluded to entrepreneurs and what they do in solving problems. And as someone who fashions themselves as one myself, you know, different version of the same question. If you're an entrepreneur starting from square one, getting into a sector, solving a problem, what do you think is the most worthwhile one from the perspective of that's ground zero. And then what we're talking about from a macro standpoint, M&A, that's the idea. That's the goal.
So you're wondering like where if I was to start a company today, where would
Yeah,
I
exactly.
go?
As opposed to if you're investing, which I know.
You know,
counterproductive.
like I said earlier, like the plumber, you know, solves the next plumbing problem. So I'm 30 years in financial services, so I can think of a lot of fintech things that I could come up with that could, you know, aid and abet the next, you know, needs for those things. But in regards, let's take this nutraceutical thing, for instance, right? Like my wife's a exercise physiologist. She's just started a health and wellness company herself. And I think I believe that is indicative of the power of the podcasting and the new technology that we have in sort of disseminating information, right? The whole biohacking craze, right? When you get into Dave Asprey and all this kind of stuff, right, is unbelievably amazing to me. And I always make a joke when I see certain people. I'm like, well, they're on the memo. And it's amazing to me how quickly a memo can go out, right? And it's because you have these podcasts and these other, distribution outlets where millions of people who are not sort of like a Jackson Pollock advertising sort of event, but a very specific targeted market. So these guys are not advertising on Channel 5 to like a bunch of no names. They're advertising to 1.5 million people every day that are interested in what they're going to say. So if one of those guys or girls say kombucha, bam, 1.5 million people are going to be drinking kombucha, even though it is good for the microbiome and it does help balance things, right? Right? Because apparently that's a whole nother thing we have to worry about now today, right? So they can instantaneously create an issue and a problem and then create the solution for it much quicker than the machine was able to do prior, right? So well, specifically in that marketplace, but so when you look at like sort of fintech innovation, they don't really have that ability to get stuff out. But what you do have is, like, for instance, I've got a fintech company that we're raising money for right now. As boring as the day is long, it solves a problem for like controllers inside large banks, right? Like, okay, what is that going to do? But it's going to take large banks like 200 controllers down to 30 people, right? So the CFO is not too interested in it, so we kind of sell it above them. But like that is solving a very, very particular problem, and like it's like making exit signs, for crying out loud. It's really boring, but it's going to do pretty well.
Everybody put a bookmark in this one because we've sufficiently broken the ice that I got a question from not Marty. Oh, wait, hold on, sir. Yeah, it's a small room, but I do like doing the whole Maury Povich thing.
I've been involved.
You can hold
You
it.
can actually hold it? Okay. Because Morty likes this, I've been involved in a prior M&A from hell. And how do you discern when you're doing a roll-up, assets to keep, but and trying to avoid the shiny obstacle or the squirrel in the corner saying, add me to it too, which sometimes makes you steer off course in an iceberg. Where do you start, from a mindset of putting definitive lines in place of not crossing over when you're doing these types of roll-ups?
I'm going to bias the sample because I want to hear from the attorney first. He sees where all the bodies are buried.
Just to clarify the question, are you saying from just to make sure you're siloing what you want versus what you don't want, or from a liability or?
And so trying to but that line may take an extra 4 or 5 months to get in the market, you can try to incorporate that aspect into it. So how do you, in your mind, discriminate, kind of a value add versus all the other aspects that you go through when you put together a solid end-to-end?
Yeah, where's the baggage? Yeah, where's the dead weight?
Yeah, I think a lot of it is like, where's your core competency, and what is this going to immediately help that bottom line, your core competency, or not? And I think we saw a lot of people in the last few years try to do a lot of things that were outside of that area. More disciplined operators and buyers are sort of staying within their lane a little bit more in order to sort of, apropos of what we said earlier about, bottom line driven economics. So, I mean, that's my best advice. The other one is, making sure that you're staying on the right side of taxes, because that very often drives how and what's acquired and when.
I think too, you match the asset with the manager, and one of the greatest M&A stories was just a couple of years ago. It was clear that the private biotech company really should be owned by one specific big pharma. The other pharmas just didn't have the infrastructure to fully utilize the lead asset, but the deal couldn't get done. And the banker in this case figured it out and went to the buyer and said, there's an early stage asset in the target that you really don't value, right? And the big pharma said, yeah, it's too far from development. And she said, okay, well, just let's cleave that off. So you buy the lead asset, which is all you care about. And that made the deal happen because the founder of Nuco was a lab rat, brilliant PhD lab rat. And that's what he cared about, was the new deal, because he had already gotten bored of the old asset. And it was just a perfect trade, right? The cool thing is when you read the press release, the banker made sure the credit went to the two CEOs. I tell you, neither one of those CEOs came up with that structure. It was the banker, but the banker did the right thing, right? And it was just genius. And anybody who knew the trade, you know, I called her the next day. I called her that day and said, "Nice work, Jen." We all knew that deal had to happen, and it was just stuck. It was stuck for months and months and months until she did it that way.
Can you also address the opportunity for carve outs?
Yeah, I was going to talk about that. Yeah, so when I was a fund manager in middle market, that's a lot of what we did. We would buy a company and we knew that, you know, that company had made acquisitions or had some divisions that had nothing to do with how we wanted the company to grow. So the first thing you did in the analysis is like how we're going to do the carve out or what we don't want and how we're going to sell that. So, and we were very successful in doing that. So we would basically, you know, make a company very lean with the carve outs, make money selling, you know, the carve outs, get their cash flow, and then make acquisitions or make investments in the technology that would make sense. And the company was leaner. And then after that, we could do a little buy and build, but not like crazy like they have done before. And then we could exit. So the problem is that sometimes when primarily middle market companies, when they have cash flow, and valuations are low like they are right now, they just go crazy buying whatever they want. Now, if you're Apple and you just go buying whatever you want, I mean, that's okay. I have my car business, I have the computer business, I have the phone business, I have, you know, so they can go crazy and say, now I'm going to buy some, I don't know, satellite business. So Apple can do that. And then that's not working out. I get rid of that. So, but a lot of those companies are not, you know, multi-billion-dollar companies, right? They're multi-million-dollar companies, but or maybe they have some billions, but and they go crazy, and then they fail because they have all those businesses that have nothing to do with their core business, and then they get in trouble, right?
Okay.
To make my trade happen, I had to kill a project that we all loved, and we had sunk $1 million into it already. And there's a great researcher here in New York that is a real rock star, and we had to deal with him. But it was going to take another 5 to 9 to 10 million to get it to market. And the way this capital markets was, and the way we had gone through one acquirer to the other, it just didn't fit the deal. So we had to just take it out and shoot it. And, you know, we can a few of us can get together and revitalize it, but not in the company that we sold.
If you're about to tell me that you guys decided to kill the hangover cure pill, there's going to be a room full of angry people in about a hot second. So let's shift gears just a little bit. I like doing this. Maybe you guys will appreciate this as well. But I always like to hear about deals that you guys were personally involved in that should not have gotten done, or should not have happened, but somehow happened. And then we can do the reverse. Maybe it's too specific of a question. I could broaden it. I see your wheels turning, Chris. You got one? Okay. What was the most difficult one to do? For whatever reason, and why? You were the one that asked for war story prompts, so like you gotta be ready for this.
Right. So you tend to remember your winners. So I got a couple of those at the top, but we did a lot of secondaries, pre-IPOs, I should say, for a lot of years, when that was a big thing. And there was one tech company that we put the SPV together and we were going at it, and then at the end we ended up chasing it a bit. We got the deal done, came out hot on the IPO, and then did not stay there. Got cold pretty quickly. So I think from sort of a black eye perspective, you got to trust your gut. I think we all felt that we were kind of chasing that price a little bit, but the hype was there, the metrics were there, everything was there, and we kind of just, with hindsight, kind of probably should have held back a little bit.
Give us the good ones. Come on, you say you remember the winners. Give us the winners.
Uh,
Was that a winner or no?
No,
That doesn't sound like a winner.
no, it was not. Actually, the company's doing quite well itself, but Wall Street really has not like embraced its valuation metric that it uses from a tech perspective. So they tend to beat it up if they were using something that, if they were using an acronym in terms of their, their business model that Wall Street approves of, I think the stock would do better, but they don't like the way they're doing it. I think I mentioned this at one other conference, but we did have an opportunity to do, and I'll tell this story briefly. We did take, from start to now, we did the Series A all the way through the Series E on a whiskey company called Uncle Nearest Whiskey. And Uncle Nearest is the very abridged story is that Jack Daniels did not actually create the Lynchburg process in Tennessee. The Lynchburg process was developed by.
What is the Lynchburg process for the non-whiskey historians?
That's when you distill over maple charcoal. And any distilling over charcoal is an old island trick. So it was a Reverend Dan Call's head slave, Nearest Green, who was the first African-American master distiller in 1856. And we got approached by an African-American woman in 2017. She, came up, she's an author by trade, came across the story. We funded her in the Series A. We're all the way, the Series A we did at an $18 million valuation. We're doing the Series E right now at an $875 million valuation. We're doing over 100 million in rev. We're in all 50 states, and we just bought a chateau in France, and we're going to be making a cognac. Because apparently, FON, the CEO and founder, found out that cognac was brought back to the United States by African-American troops after World War I because they were stationed in that part of France. So that kind of gets to that correlation. So now we're raising some money to go build out the cognac business. So that's been the winner.
Nice. Did they have an event space in there? Just asking for a friend. Okay.
We financed the building of a distillery outside of Nashville in Shelbyville, and now we're doing about 8,000 people a weekend. We got the distillery, we got a museum, we got a bunch of horses. I mean, it's kind of a big thing. I think Maker's Mark has a destination location as well as do a couple of others. But yeah, it's we've put Shelbyville on the map. All of a sudden, it was like this little town in the middle of nowhere.
Hey, Marty, that's the next IvyFON? Yeah, that's where we're going. Yeah, the chateau. Let's go to the chateau. Yeah. Yeah. All right.
Okay, cool. So we found out we got some country music fans. I like it. We're learning a lot about this group.
Dan, I got a bus for you.
Okay, yeah.
Let's
Yeah,
go anyway.
Let's do it.
So a banker brought me this entrepreneur in the deal, and the deal made sense. Not really because of its core business, but it was like back in 1999, it had micropayments. And I said, micropayment, that's the real asset. Unfortunately, the founder, CEO, MIT grad, really sharp person, was all about educating children on how to do computer programming, which was an important thing also, but not a money-making thing. And so we raised the money. She continued to push it in her direction, which is her vision. And we ended up, selling it for a pittance. And of course, the buyer was seeing the value I saw, the micropayments. So it was, we should have just, in a lot of cases, like after Cisco Systems went public, I banked Len Bozak, and a year later, the board fired him, right? And brought in John Chambers to run the company. And John was the right guy at the right time for 20 years, did a wonderful job. And Len was wonderful to get it to that stage, but he was not, I love you, Len, but Len was not the right guy to do what John did for the next 20 years.
David, are you going to respond to this? Can you hold it for? No, you can't hold it. Okay.
No, I was just going to say to answer, I think I can answer both of your questions, which is a win for me, but a deal that shouldn't have happened. I was on the sell side in 2018 of a cannabis company that had trailing 12-month revenue of less than $3 million and sold for over 200 million bucks. 18 months later, the buyer wrote down the entire asset.
But cannabis what though? Just selling.
They claim, they had No. They had some, they had some branded products, but they also claimed to have some research around, the cannabinoid receptors and how it all worked together. And in 2018, there was, when you talk about stupid valuations, this was like the king and queen of stupid valuations. And so my client walked off very, very handsomely. And like I said, it was a win for them and a deal that never should have happened.
I think the moral of that story is the old proverb goes, don't get high on your own supply. I think that fits.
Actually, that
I wanted
was-
to say it.
That was not getting high on somebody else's supply because they should never have bought.
Yeah, I know, but their cannabinoid research, I probably know what that looked like, and
Yeah.
it involved a good amount of junk food.
Yeah.
Uh-huh.
I have a $38 million carve out that came to me. It's healthcare. And this woman was heading up the research for the company and they shut it down because of high rates in the stock market. And she says, they given me this $38 million asset. They're keeping 20%. I have the rest and I have no money to fund it. So what would you do? Number one. And then number two, there's another guy we know who's got this fantastic technology, which he's actually, making money. He's cash flow positive. He's like, I want to sell. He's a healthcare company. I want to sell, but actually from a platform point of view, the technology can be used in multiple different cases. It is AI powered for lab equipment. So what's the how do you decide between selling versus licensing? So selling versus licensing, and when somebody has a great asset but they have no capital, what are the options?
I'm very respectful of the market as an investor, but as an operating executive, I've concluded that I have to almost be blind to the market. I have to believe that I've affiliated myself with the best damn science in that sector and the best management team. And if it's not the best management team, I'm going to recruit around me. And then we're going to make that pitch, because all I need to do is is make this one company succeed. I don't care about my sector. I don't care about the industry. I don't care about the market, because I become laser focused, and that's the way I create alpha in my personal account. So, like a room full of people here or a room full of any people in New York, you're going to have a few people who are former Goldman partners. And you're going to have a few people who are not investing, but you're also going to have a few people who, like were in my trade, or a few people who've gotten a realization and do have capital. And all you got to do is, I think, I've always thought this as a banker and as a co-investor, you just have to, you create your right Excel spreadsheet and focus in on that universe of investors who care about your sector, and then, work it and hopefully find that one or two who have the capital right now and the story resonates with them. I think licensing versus sell, it's based on how tired your investor base is and how tired your management team is. We sold because our investor base had been told repeatedly that it would light right around the corner, and then COVID hit, and then this happened. And I think our communication before I got there was not perfect with the board. I'm a board member myself, so I like to get the board package out 2 weeks in advance, canvass all the managers with the answers that I don't have, and anticipate, like, if I'm on this board, what do I care about right now? So if I have a good package, then the board can do what they supposed to do, it's strategize. They say, hey, Brand and CEO, you've answered all of our questions. But if you're always gilding the lily and saying it's going to be fine next week, fine next month, you tire out your investor base. And so that's why we couldn't wait for, we had opportunities to do it. And also, I think you mentioned that, corporations, big corporations take forever, right? There were a lot of corporations who still want to co-market our product, and they may still, but they were moving at a glacial pace. And we were, we found that the M&A market was a faster market for us in that case.
That's why I wanted to answer your first question that you didn't follow through with any of us. If we had like a new business, so I would do anything with Taylor Swift related to Taylor Swift.
That's it's not the worst. It's not the worst
That would
idea.
tell anything.
Yeah. Marty, how are we doing on time? 2 minutes. Okay.
Yeah, on the licensing, so I think it depends on the sector, right? If you're talking about software licensing versus branding licensing, I don't know what your question was.
That, it they presented many times to our group, and our group presented for a lot of money, and there's no fatigue on the investment side at all.
Mhm.
I've been looking at big payouts one way or the other. The real issue is if they sell it to a company, the company may only use one application of it when there are 20 applications, right? And that's, you know, and the guy who started the company is like, I'm the daddy of this thing, I want to make sure
Right.
my children live, right? So that's,
Right.
that's the issue.
And then you need a number of vertical sales forces to.
So there's no way he can ever do it. There's no amount of venture capital to supply, make this happen. It has to go to somebody where you can license it to all the major players.
No, it's interesting because I've been involved in licensing deals where the impetus is for market penetration. Let's just get it out there so more people can see and recognize and play with it. And then I've been on the side where people say, no, people know who we are. We want a license because we want to hold on to it and we think we're going to monetize it better, right? So I think it really, I know this is an annoying lawyerly answer, but it really depends on sort of what side of the coin are you there? Because if it's, hey, we want to grow and get some more market penetration, it's one model. And if it's, hey, we think we're the best people to own this, right? On a go forward basis, then the licensing model makes sense there for a totally different reason.
My same question came up because more mature investors or former bankers are saying, why don't you license because you're gonna maybe make a lot more money and then control the destiny.
And it's the strategy of the last few years. I mean, like the street was telling us point blank, we don't want to fund the build out of another sales force in your sector, in your industry. They said, this company, I won't name the public companies, but this company has an underutilized sales force. He said, yeah, we know we're talking with them. And this group has an underutilized sales force. Yeah, we know we're talking with them. So the street was pushing back once rates started to move up. We love you guys. You got a great product, but we're not going to fund you to build out yet another underutilized sales force. And that's when you license.
We're good. All right. So last thing I'll say is give a big round of applause for these guys and thank you for being a cooperative audience.